The day after you buy your house, your mortgage might already be gone. Not paid off, sold, to someone you've never met. And the bank that shook your hand, they may not even want your loan. Because your mortgage is not the product, you are. And by the end of this video, you'll see why your 30-year home loan is actually part of a machine much bigger than your house. Right now in America, housing feels tight. Rates are high, payments are painful, prices refuse to fall. Millions of Americans are locked into mortgages they can't refinance. Others are stretching just to qualify. But here's the part most people miss. Banks don't make most of their money by holding your mortgage. They make money by selling it. And when rates rise, when inflation spikes, when the Fed tightens, this machine starts to strain. You saw pieces of it in 2008. You saw warning signs again when regional banks shook in 2023. But the machine never stopped. It just evolved. Let's simplify this. You walk into a bank. You ask for $400,000. They approve you. You sign 200 pages. You think, I now owe this bank for 30 years. But here's what often happens next. Within weeks, sometimes days, your loan is bundled with thousands of others, put into a giant financial package, and sold to investors. This package is called a mortgage-backed security. But don't think of it as complicated finance. Think of it like this. Your monthly payment, it becomes income for someone on Wall Street. Pension funds, insurance companies, global investors. They buy the right to receive your payments. So the bank that gave you the loan, they already got paid. They free up their balance sheet, and they go make another loan, and another, and another. This is how $1 turns into many mortgages. This is how housing credit expands fast. And this is why the housing market can inflate so quickly. Because the real product isn't the house, it's the stream of payments. Now here's where tension builds. When rates are low, investors love these mortgage bundles. They look safe. Americans always pay their homes first. So demand for these securities rises, which means banks can originate more loans, which means more buyers enter the housing market, which pushes prices up. Cheap money feeds housing. Housing feeds more lending. More lending feeds Wall Street. It becomes a loop. But loops work both ways. When rates rise sharply, mortgage payments jump, refinancing dies, housing demand cools, and the value of those mortgage-backed securities can fall. That's exactly what hurt banks holding long-term mortgage assets when rates spiked. Suddenly, assets that looked safe start losing value. Liquidity tightens, credit slows. And when credit slows in America, everything slows. Because housing is not just shelter, it's collateral, it's leverage, it's economic fuel. You might be thinking, so what? I just make my payment. But here's why this matters to you. Your mortgage rate is influenced by global investors, not just your local bank. Your home value is influenced by credit availability, not just supply and demand in your neighborhood. If this mortgage machine speeds up, prices can surge. If it freezes, prices can stall or fall. Your biggest asset sits inside this system, and you don't control the machine. You're plugged into it. Even if you never refinance, even if you never move, your home is tied to a global market for debt. Here's the uncomfortable truth. Banks are not primarily in the business of owning homes. They're in the business of manufacturing loans. Originate, package, sell, repeat. Your 30-year commitment, for them, it might be a 30-day transaction. That doesn't make it evil. It makes it mechanical, efficient, scaled. But it also means housing booms and housing stress can spread faster than most people realize, because once mortgages become financial products, they behave like financial products. They get traded, priced, repriced, and sometimes mispriced. So next time you look at your house, ask yourself this. Did you buy a home, or did you enter a 30-year position in a global debt market? And if Wall Street depends on your payment stream, what happens when enough people can't pay? That's not just a housing question, that's a system question.